How much money can I get on a reverse mortgage? That's today's focus in our How Do Reverse Mortgages Work video series. There are currently two types of reverse mortgages: the HECM, an FHA-insured home equity conversion mortgage, and a proprietary reverse mortgage for more expensive homes. The FHA HECM is the one you see advertised on TV. The proprietary reverse is often referred to as a jumbo reverse. The jumbo reverse mortgage was prevalent 10 years ago, but it disappeared when the housing and stock market crashed in 2008. Most borrowers believe they can borrow roughly half the value of their home. They are correct when the home is worth less than $640,000. But when a home is worth more than $640,000, borrowers are often disappointed. There are two reasons borrowers cannot get as much as they want or expect. One is a function of how reverse mortgage loan limits are calculated. Two, recent HUD changes were designed to make the reverse mortgage program more sustainable. Understanding how maximum loan amounts are calculated requires defining terms and a little math. These are the three government terms or acronyms to know: MCA, NLL, and PLF. MCA stands for Maximum Claim Amount. MCA is a proxy for value, and it is defined as the lesser of current appraised value, national lending limit, or contract purchase price. Purchase price only matters if someone is using a reverse to buy a home. Most people don't know that you can use a reverse mortgage to buy a house. When someone buys a house with a reverse, they have no mortgage payment. Using a reverse to purchase a house is known as an H4P, or HECM for purchase. H4P helps seniors downsize to a home that better suits their needs and budget. NLL stands for National Lending Limit, which was recently increased to $636,150. NLL is an arbitrary number set by the Federal Housing Finance Agency. The formula to calculate how much a borrower can get is the smaller of the appraised value, the purchase price, if H4P, or the national lending limit. If a home's value is greater than $636,000, the borrower does not get more money. This really confuses and irritates people with high-value homes. Defining a home's value as a maximum claim amount is a foreign concept. The reason the government set a national lending limit and a maximum claim amount is because they do not want to insure big reverse mortgages on high-priced homes. FHA-insured reverse mortgages were actually designed to help average homeowners access some of their wealth to pay retirement expenses without having to sell their house. The national lending limit is not a limit on how much the loan balance can grow to. It only comes into play when calculating the initial loan amount or principal limit. PLF stands for Principal Limit Factor. PLFs are just numbers in a table published by HUD, the Department of Housing and Urban Development. They define what percentage of a home's value someone can borrow. When rates are low, people can borrow 52 to 75% of the MCA, depending on the youngest borrower's age. When interest rates go up, the amount people can access goes down considerably. Some people think, I'll wait until I'm older to get a reverse mortgage so I can get more money. If rates rise, even though they're older, they'll end up getting a lot less money. And waiting means risking house values dropping, which would result in less money. To calculate how much someone can borrow, known as the principal limit, multiply the maximum claim amount, value, times the principal limit factor. Principal limit, or max loan amount, equals MCA times PLF. Here's an example. A homeowner, age 62, with a $636,150 value, can get $636,150 times 52.4%, which equals $333,342. Notice, this is the same amount that someone with a higher value house could borrow. Remember, the formula is based on the national lending limit or the appraisal. whichever is less. An older borrower can access a higher percentage of their principal limit. If a 90-year-old has a $636,150 house, they could borrow up to $477,112, that is 75%. Jumbo reverse mortgages allow those with higher value homes to get more than with an FHA HECM, sometimes. Jumbos offer more when a house is worth over $1.2 million and the borrower is over 70. The following chart shows the difference in borrowing power between the FHA and Jumbo reverse. You'll notice across the bottom are the ages from 62 to 90, and on the left-hand side, you'll notice the maximum loan amount. The green line represents the principal limit for an FHA reverse mortgage. The blue line represents the principal limit for a jumbo reverse. Notice, above age 70, the homeowner can access more with the jumbo reverse. However, notice that below age 70, the jumbo offers less money. A 2015 FHA rule change now limits how much a borrower can access in the first year. Borrowers are now limited to accessing only 60% of their principal limit in year one. FHA's goal was to slow down the withdrawal rate so the money would last longer. The only exception is when the house has an existing mortgage to be paid off, and doing so requires a loan amount greater than 60% of the principal limit. With a reverse mortgage, all existing home loans and liens must be paid off. Borrowers can get more than 60% to pay off existing liens as long as the total is less than the principal limit. They can also get an additional 10% in cash, so long as the total is less than the limit. Example 1. A 62-year-old has a $600,000 home that's paid off. The principal limit would be $314,400. The 60% rule limits borrower proceeds in year one to $314,400 times 60%, which is equal to $188,640. At the beginning of year two, they can access the remainder, $314,400 minus $188,640, which is equal to $125,760. Example 2. A 62-year-old owns a $600,000 home with a $260,000 mortgage. They can access $260,000 to pay off the mortgage plus 10% of their principal limit at closing. So they can get $260,000 plus 10% of the principal limit, which equals $291,440 at closing. Then 1 year later, they can access the remainder, which is $22,960. In both cases, they can access the same amount, $314,400. Only the timing is different. Example 1 was $188,640 in year 1, $125,760 in year 2. Example 2, $291,440 in year 1, but $22,960 in year 2. These numbers do not include fees or charges paid from loan proceeds. Rates and loan limits can and do change. For a free, no-obligation conversation about improving your monthly cash flow, call Kent at 800-208-1252. Kent Kopen is a certified reverse mortgage professional. You can find out more by going to www.thereverseadvisor.com.